There is a window closing right now. Not metaphorically, not in some vague, abstract financial commentary kind of way. I mean a literal, measurable, ticking clock window. And if you are watching this video, you are inside it. You have roughly 3 days before something happens in this gold market that could completely change the math on every purchase you were thinking about making. And I'm going to walk you through exactly what that is, why it matters more than almost anything that has happened in the precious metals space in years, and what the people who study this market for a living are quietly doing with their own money right now, while the mainstream financial press is still running stories about tech stocks and AI valuations. But first, let me tell you about a guy named Gerald. Gerald is not a famous investor. He doesn't have a hedge fund. He doesn't appear on CNBC. Gerald is a retired engineer from Ohio who spent 35 years building things that actually work: bridges, water treatment systems, the kind of infrastructure that holds a civilization together. And when Gerald retired, he did what most people in his generation did. He parked the bulk of his wealth in a traditional retirement account, a mix of stocks and bonds, and he trusted the system. Because the system had always worked. Until it started not to. Gerald told me, and this is a real conversation I want you to sit with. He said, I watched my account do things I didn't understand. Up 20% one year, then down 30 the next. My financial advisor kept telling me it was normal volatility, but I'm retired. I don't have 20 years to wait for volatility to smooth out. Every time that account dropped, I was eating real losses, real money, gone. Gerald's story is not unique. In fact, it is one of the most common stories in the retirement landscape right now. And it is the exact reason why what is happening in the gold market over the next 72 hours is so important for people like Gerald. People who have worked their entire lives, accumulated real wealth, and now find themselves exposed to a financial system that is behaving in ways that nobody who designed their retirement plan ever anticipated. So let's get into it. The Federal Reserve is in session right now. As you're watching this video, the most powerful monetary body on the planet is sitting in a room, looking at an inflation number that came in at over 4% on the last major report, trying to decide what to do with interest rates in an environment where geopolitical tensions have driven energy prices through the roof and where the labor market is still running hotter than they want it to. The decision they make, and it is coming within the next few days, is going to send a signal. And that signal will ripple through the gold market in a way that creates a very specific, very narrow buying opportunity that sophisticated investors have been positioning for quietly for weeks. Here is what makes this moment so unusual. Gold recently came off of an all-time high that was genuinely historic. We're talking about a price level that no one who learned about gold from a textbook would have predicted when they were studying. And now, gold has pulled back, meaningfully. That pullback happened fast, driven largely by the same energy inflation story that has the Fed in that room right now. Higher inflation expectations triggered speculation about rate hikes, and rate hike speculation is historically one of the few things that creates downward pressure on gold in the short term. So gold dropped. It dropped hard. And now it is sitting at a level that the major institutional players, JP Morgan, Goldman Sachs, the sovereign wealth funds that don't make press releases, are looking at the way a buyer looks at a house that just had a price reduction. Think about that for a second. Gold pulled back from its all-time high. The fundamentals that drove that high have not changed. Central banks around the world bought nearly 250 tons of gold in just the first 3 months of this year alone. That's not a typo. 1/4, 250 tons. The pace of central bank accumulation is running at some of the highest levels ever recorded. These are the institutions that have entire floors of economists and analysts and geopolitical strategists telling them what to do with national reserves. And what they are doing, right now, actively, aggressively, is buying gold. Quick aside, if you have $100,000 or more sitting in a retirement account right now, I put together a free guide in the description that breaks down exactly how thousands of American retirees are using what I call the saving secrets of precious metals to protect their hard-earned wealth. It's completely free. It walks through the fundamentals in plain language. Check the description and grab it. Okay, back to what is happening in this market. The reason the 3-day window matters is this. Whatever the Fed decides, gold wins. Let me explain that, because it sounds too simple, and I know your instinct is to push back on it. If the Fed raises rates to fight inflation, that signals to the market that the inflation problem is real, that the energy disruption from ongoing geopolitical conflicts is not going away, and that the purchasing power of the dollar is under genuine, sustained pressure. All of those things are historically bullish for gold. Every time in modern financial history that real inflation has persisted, meaning inflation that outpaces interest rates even after the hikes, gold has performed. Every time. On the other hand, if the Fed holds rates or signals that they're done hiking, that immediately weakens the dollar, pushes real yields lower, and removes the only argument that bears have been making against gold for the past few months. The moment that pressure releases, you could see gold move back toward its all-time high with speed that would make a pullback buyer feel like a genius. This is what traders call a binary event with a non-binary outcome for gold. Either path leads to the same destination. The only question is how fast you get there. Now, I want to zoom out for a second because I think context is everything in this kind of market, and I never want to give you the impression that I'm just talking about a 3-day trade. What we are watching in the gold market right now is part of something much, much larger. And to understand it, you have to go back, way back, to a moment that most people alive today either don't remember or were never taught about. In 1971, the President of the United States walked into the Oval Office, sat down in front of a television camera, and told the world that the United States was suspending the convertibility of the dollar to gold. Just like that. No vote, no referendum. 50-plus years of a monetary system that anchored the dollar to a physical asset, gone. Overnight. What happened in the years that followed was one of the most dramatic transfers of wealth in modern history. Inflation exploded. Gold, which had been held artificially low by government intervention, went from under $40 an ounce to over $800 an ounce over the course of the next decade. $800. The people who understood what was happening and positioned themselves accordingly didn't just preserve their wealth, they multiplied it. The people who didn't understand what was happening, the people who kept their savings in cash, in bonds, in dollar-denominated assets, watched their purchasing power evaporate in real time. Not because their account balance went down, sometimes it actually went up on paper, but because everything that account balance could buy kept getting more expensive faster than the number could grow. Fast forward to 1980. There's a different story happening, but with the same underlying mechanics. The Hunt brothers, Nelson and William, had figured out something that the rest of the market hadn't fully priced in yet. The paper silver market was completely detached from the physical reality of actual supply. They started accumulating physical metal at a scale that had never been seen by private individuals. At the peak of their accumulation, they held what some estimates put at a third of the world's entire private silver supply. The price went from under $2 an ounce to nearly $50. That's a move of over 20 times in a handful of years. And when the exchange rules changed to stop them, when the powers that be literally changed the rules of the game mid-play, even that couldn't undo the fundamental truth they had uncovered, that the paper market for precious metals can diverge dramatically from physical reality. And when those two things converge, the price moves can be breathtaking. That same dynamic, paper versus physical, is playing out right now in a way that sophisticated analysts haven't seen since 2011. The COMEX, which is the primary exchange where gold and silver futures are traded in the United States, operates on a system where the vast majority of contracts are settled in cash rather than in physical metal. Most people who trade gold on COMEX never take delivery. But here's what's changing. The ratio of paper contracts to available physical metal has been stretching to historic extremes, and a growing number of institutional buyers, not retail, institutional, have started demanding actual delivery, physical gold, the real thing, in a vault under their name. When that happens at scale, the mechanics of the market change. The paper price has to converge with the physical reality, and the physical reality right now is the demand. From central banks, from individual buyers in Asia and the Middle East, from institutions hedging against dollar instability, is running well ahead of what the mining industry can produce. Gold does not grow in a laboratory. You cannot print it, you cannot conjure it. Every ounce that comes out of the ground requires years of exploration, permitting, development, and capital expenditure. And the supply pipeline for new mines is not anywhere close to matching the demand picture that is developing. The 2008 financial crisis is another chapter of this story worth sitting with. Leading up to that collapse, there were signals everywhere for people who knew how to read them. The mortgage market was manufacturing paper wealth at a pace completely disconnected from underlying asset values. And when that paper wealth evaporated, when Bear Stearns collapsed, when Lehman went under, when the whole edifice of leverage and complexity started coming apart, gold was one of the very few assets that held its value, and then went on to reach new highs in the years that followed. The people who had allocated a portion of their retirement savings to physical gold before 2008 looked very different on the other side of that crisis than the people who were fully exposed to the financial system. We are now in an environment with more total global debt than at any point in recorded history. The United States alone is running annual deficits that would have been considered science fiction a generation ago. And these aren't temporary deficits driven by a one-time emergency. They are structural, meaning they exist even in years when the economy is technically growing. The only way governments have historically dealt with debt at this scale is through one of two paths: either explicit default, which is politically impossible, or monetary debasement, inflating the currency until the real value of the debt shrinks. Gold has been the antidote to monetary debasement for 5,000 years, not because of tradition, not because of sentiment, but because it cannot be manufactured, cannot be inflated, and does not carry counterparty risk. And now, add to that the geopolitical layer, because this is where the story of gold in this era gets truly remarkable. The BRICS coalition, which now includes countries representing a majority of the world's population and a significant portion of its productive capacity, has been actively working to create trade settlement mechanisms that do not rely on the dollar. This is a fundamental shift in the post-World War II monetary architecture that the United States has operated within and benefited from for decades. The petrodollar system, the arrangement where oil is priced and traded in US dollars globally, is under the most serious challenge it has faced since its creation. And the asset that is being discussed, accumulated, and quietly positioned as the potential anchor for any alternative system is gold. This is not conspiracy. This is on the public record. Central banks in China, Russia, India, and across the Middle East have been publishing their gold purchases, making statements about reserve diversification, and in some cases explicitly discussing the role of gold in reducing dollar dependency. When the institutions managing the reserves of sovereign nations are moving in the same direction at the same time, it tells you something important about where the smart money believes this is going. Here's where I want to talk to you directly, because if you've been watching this channel for any length of time, you know that I don't just cover markets academically. I cover them from the perspective of what this means for real people. People who are approaching retirement, people who are in retirement, people who have spent decades accumulating wealth and now need that wealth to actually work for them in a world that is increasingly unpredictable. The combination of what I just described, an imminent Fed decision that is bullish for gold either way, a technical pullback that has created an entry point that institutional investors are actively using, a structural supply-demand imbalance, a global de-dollarization movement that has central banks buying gold at record rates, and a geopolitical backdrop that has no sign of resolving. This combination does not come along often. It is the kind of convergence that, looking back, people say, that was obvious in hindsight. But here's the thing about hindsight. It's free. Acting in the moment is where the wealth is actually made. Now I want to spend a few minutes on something that not enough people are talking about, which is the mechanism by which ordinary Americans, who already have retirement savings, can actually participate in what is happening in this market, not through a paper ETF that holds claims on gold rather than gold itself, not through mining stocks that carry their own set of operational risks, but through actual physical gold held in a tax-advantaged retirement account, a gold IRA. This is not a complicated concept, but there is a lot of confusion about it, and that confusion costs people money. Under existing IRS rules, it is completely legal to hold IRS-approved physical precious metals, gold, silver, platinum, palladium, inside an individual retirement account. The metals have to meet certain purity standards. They have to be held by an approved custodian. And the rollover process, when done correctly, does not trigger any taxes or early withdrawal penalties. The money moves from your existing IRA or 401k directly into a self-directed IRA that holds physical metal. You never touch the money. You never pay taxes on the transfer. The gold sits in a secured depository, fully insured under your name. For someone sitting on a substantial retirement account, and I'm talking about people with $100,000 or more, This is the mechanism that allows you to take a real position in physical gold inside the same tax-advantaged wrapper you've been building for decades. And given where the fundamentals are pointing, the question isn't really whether gold deserves a place in a retirement portfolio. The question is whether now, with the pullback that has occurred and the catalysts that are lined up over the next few days, is the moment to act. I'm going to give you my honest read on this. The window that exists right now, the combination of a meaningful price reduction from the recent highs, major institutional targets that are significantly above current levels, central bank demand running at historic rates, and a Fed decision imminent that resolves in gold's favor, regardless of outcome. This window is narrow. The pullback that has given us this entry point was driven by temporary factors. The Iran situation, the energy inflation spike, the hawkish speculation around the Fed, those factors are already priced in. The market has already processed the bad news. What it hasn't processed yet is the good news that is coming. And here is what I find most compelling about this moment. Look at where the major financial institutions have set their targets. These are not precious metals bugs. These are the same banks that have clients in the hundreds of billions of dollars. When organizations at that scale have year-end targets that are dramatically above where gold is trading right now, they are not publishing those targets for entertainment. They are publishing them because their analysts, their risk models, and their investment committees have run the numbers and believe it. The supply picture alone justifies a significant move higher. Mining companies have been underinvesting in new project development for years because capital was cheap, returns in other sectors looked better, and the permitting environment for new mines in most Western countries has gotten progressively harder. The projects that were approved and funded 5 to 10 years ago are the ones producing today. The pipeline of projects that would need to come online to match current demand trajectories is thin. That supply constraint doesn't resolve in 3 days. It doesn't resolve in 3 months. It is a multi-year structural reality that sits underneath this market like bedrock. And the demand side isn't slowing down. Not from central banks, not from Asian buyers who have a 5,000-year cultural relationship with gold as the ultimate store of value. Not from the institutional investors who are watching the debt dynamics of Western governments and deciding they need a portion of their portfolio that cannot be inflated away. The demand picture is broad, it is deep, and it is growing. I've talked to a lot of people over the years about gold, and the one thing that consistently strikes me is the difference between the people who act on information like this and the people who file it away as interesting and do nothing. The people who act are not always the ones with the most money, the most sophistication, or the best timing. They are simply the ones who decided that the risk of doing nothing was greater than the risk of doing something. Because here's the thing about a window like this. It doesn't send you a notification when it closes. You don't get a message that says, the Fed just decided and gold moved 12%. You missed it. The window closes, the moment passes, and you're left watching from the outside, wondering what would have happened if you had just taken the step. For those of you who have been curious about gold but haven't made a move yet, this is the moment I would point to. Not because of any single data point, but because of the totality of what is converging right now in this market. The pullback, the Fed catalyst, the institutional positioning, the central bank demand, the de-dollarization trend, the supply constraint, the historical precedents from 1971, from 1980, from 2008, from 2011. Every one of those periods had a moment exactly like this one, where the smart move looked obvious in retrospect and difficult in real time. The difficulty is what creates the opportunity. If this were easy to see, it would already be priced in. The fact that gold is sitting at a discount to its all-time high, with all of these tailwinds lined up, is itself the signal. For everyone who's watched all the way through today, I want you to know something. There is a free educational resource in the description of this video, a guide that walks through the practical steps that thousands of American retirees are using to protect their hard-earned wealth through precious metals. It's free, no strings attached. Check it out, share it with someone who needs it. And for those of you who are serious about this, who have $100,000 or more in a retirement account and want to actually understand what a gold IRA would look like in your specific situation, there is something special available only to people who watched to the end of this video. If you mention that you watched through to the end when you reach out, you will get access to an exclusive one-on-one educational web conference, completely free, completely no obligation, where we walk through your specific situation, your existing accounts, and exactly how the rollover process would work for you. That offer is not available everywhere. It is available to American retirees with 100,000 or more in any retirement account who saw it here and are ready to have a real conversation. The 3-day window is real. The fundamentals are real. The question is what you're going to do about it. The guide is in the description. Use it.